What if I told you that you could know your exact probability of success before placing any option trade? Well, Webull just made that possible with this incredible probability analysis feature, and most traders have no idea it exists. Hi, I'm Telex. In this video, we are going to break down this game-changing tool using a real NVIDIA option example ahead of the earning release today, Wednesday, after the market close on August 27. By the end of this video, you will know exactly how to use this feature to drastically improve your option trading success rate. Hey, if you have not subscribed yet, please hit that subscribe button, because we are going to be diving into Webull's most powerful hidden features every single week on this channel. So, what is a probability analysis for option? Let me show you what we are looking at here. This is NVIDIA. At the time when I did this capture, the stock was trading at 181.34 cents, and I've pulled Webull probability analysis tool. The curve that we are looking at is showing us a range of prices. The bottom line is showing us prices coming down, let's say from the current center of the price around 180 all the way to 134, and then the upper side showing you increasing prices all the way from 180 going to 200 and 229. So the important thing are the numbers at the bottom. So the numbers at the bottom represent the probability of hitting a certain price by a given expiration date. So the number on the horizontal axis here, they may seem confusing, but they are not. So look, for instance, between August 29, which is the closest expiration from today, to September 5th, there are 10 days. So they're counting the number of days. That's what you see on there. And then the expiration, as you know, the weekly, and then monthly expiration, they are ranging from 29th of August, 5th of September, all the way to December 19. So if we want to take a quick look here, let's focus on August the 29th. So it's showing us that, hey, the probability of the stock finishing above $199 is 2.68%. Just think about that. For those who are buying calls for earnings, this is a great tool on here just for that specific application. I want us to remember that as we are going to jump now into the tool, and I want to show you exactly how to find it. So let's go to a Webull on here. So this is the option chain of NVIDIA. So next to option chain, there's option statistic, and then there's probability analysis. So this is live, what it looks like. So the description that we just saw here, this one is live as at the time of the recording on here. Mathematically, I want us to focus on the fact that the probability range on the bottom right hand side, there are three choices on here, right? So 95%, meaning that there's more movement into the stock. So the shape of the curve will actually enlarge itself, because let's say here 95% we have prices going all the way on the upper hand side to 300, on the bottom on here to 103, compared to 68%, which is that 68.25%, it's for normal conditions of the market. So that's very important. I think that under normal conditions of the market, these are the ranges of prices that NVIDIA can go up or down. That's the important parts for us to take away on here. So above 199.8, as we are looking at it, probability for this Friday expiration is only 2.68%. If we want to increase our probability, we have to extend to 1 week later. 2 weeks later, we jump to 17%. 4 weeks later, we jump to 20%, and so forth. As you can see here, obviously, the more time, as you know in option, right, the more time that we give ourselves, the more money we have to pay. Yeah, the more money you have to pay from there. So in terms of practical applications, there are two things on here that's we really need to focus on. Let's start with the first part, which is income traders, meaning people who are selling cover calls. Yeah, great application onto using this curve, because if I'm selling cover calls, for instance, this coming Friday because of this earning, and I'm selling the 200 strike price, the probability of that being in the money, meaning being above 200, is only 2.68. By the way, the opposite of it is if you want to go the other way around. So let's say, okay, actually, if you're selling cover call, in this case, your option seller, you look at this one because it's telling you that probability of being out of the money. So meaning I'm selling the 200, being out of the money. Below that, I have a 97.32% success rate. Similarly, this other one on here, because the selling of the put. So if I'm selling put, probability of being below 1.63.54 is 98%. So the success rate here for somebody who's selling puts at 160 strike is this one. So this creates really a wide profit range where you win if NVIDIA stay within 160 and 200 and you're using a clever strategy of selling calls at 200 strike price or selling puts cash cover, selling puts at 160 strike price. The other way around, if you are not a so-called market maker, if you will, it's, let's say, if you're a directional trader, yeah, if you think that NVIDIA will be breaking higher, let's say after this earning, you need to go up above 199 really for you to be able to beat the odds. Those odds for a trader who buy, let's say 199, a 200 strike price, the probability of that hitting this Friday is only 2.68. The next Friday, the following Friday, 5th of September, you have to pay for more money, right? 11% and so forth. So this is how you go about using that. So the application lend itself, or if you think that will be crashing because of possible earning, right? Below 163. So let's say if you want 160 strike on the put, your probability of winning is only 1.84%. Yeah. So this is that one takeaway. The other way, still, if you're buying option, straight up not selling them, it's to look at using this to help yourself into picking the proper strike price. So what does this tell us? So let's say if I'm thinking I'm bullish and I want to buy calls, right? So I say, okay, let me try to find a good expiration date for the 200 strike. Yeah. Well, the chart here, it bring in a great deal of information. Let's focus on this last two here. November 21st versus December the 19th. You will pay, actually, we will go to the option chain shortly here to look at the price of these, right? These two. The delta, the difference on here, yeah, I slept on there because you know where I'm going with that. The probability of winning on that trade, of being in the money, yeah, it's 30.5% for November the 21st and let's say 32%. It's not that much, but there is a huge price difference because the time difference here between these two expiration is a whole month. So there's a huge difference on here. So hence for me, if I come in, I'd rather spend less money on there. So let's go ahead and actually go to the option chain to illustrate that. So we want to look at strike price expiring November 21st versus 200 strike price expiring December the 19th to look at the price difference, because in terms of probability of those two expiration is the same. So this one, the 200 is worth $8. We are going to take, let's say, even the bid, yeah, $8.15. So that $815 versus a month later, yeah, which usually traders could say, oh, I'm giving myself more time, but your probability is not any higher. $10.25. So there is a whopping more than $2 difference between those two. That's a lot for just a difference of 1% in probability of success. That's what it's showing here. So 1.3% in probability of success. This is a practical application on here on how to go about using the probability analysis from Webull. So there's one caveat that I want to say. So this is a tool. So now before we go and bet the farm, let's talk about what this tool cannot do, right? This is based on the Black-Scholes assumption. So the model assumes that normal market condition, it doesn't predict, for instance, surprises that we have during earnings, big surprises. Or if you're using this for a stock like a pharmaceutical stock, you know, those which have FDA approvals that just come out of the blue, or during market crashes, or if somebody tweets, yeah, this model doesn't assume any of that. So that's 1% or 2% probability can definitely derail your trading strategy. Therefore, position sizing is still crucial. My preferred technique, let's say if I am bullish on a stock, I always hedge. So I will use, let's say, a 20 to 30% hedge when I'm really confident. And the way that I offset that, so let's say in this case, right? So if I'm buying something, let's say 1 month out, for my main position, my hedge will be a much closer expiration so that I do not have to spend that much money. Yeah. This is something that we explain as successful tradings on here. So just be mindful of that. So before we go, I would like to just bring a summary of what we gather here today. So want you to, or your action, your call to action, if you will, open your Webull and find the probability analysis feature, as we just said. Practice reading the curve on stock you know well. So as a matter of fact, please in the comments, give me your preferred stock so that we will feature it in the next video, exactly what that probability analysis look for your preferred stock, so that you can feel more confident about using it. Use then the probability analysis here to improve your strike selections, strike price / expiration. Those two go hand in hand. And remember, high probability doesn't mean that we have a guaranteed profit. A professional always hedge. So let's get into the habit of hedging. And the last thing is to always position yourself, position yourself appropriately, meaning your size based on the risk factor that you are willing to accept. So thank you for your time. May wherever you're watching from, have a great evening, and we catch you on the next episode. Bye-bye.